Hi, and welcome to Macro Monday. We talk macro and try to make sense of markets that really don't make any sense. I'm your host, Steve Van Meter, and today we're going to have to revisit digital currencies and talk about the hottest subject over the weekend. Is the IMF signaling for another Bretton Woods agreement? Plus, we got to take a look at the big positioning in the in the speculative market in the futures market and see how hedge funds are deeply short the 30-year. That's only going to lead to an unwind and lower interest rates, higher bond prices. So let's come back to Friday, right? Or was it Wednesday when I went on my rant about digital currencies? I think, and I appreciate the feedback. Here's what's going on, right? Why is the whole talk about digital currency? Remember we just had a coin shortage, from the pandemic. Now, why did that happen? Because there's something called the velocity of money, which you can simply explain as money moving between people's hands. So paper currency, coin currency, it gets moved around the system. There's never actually enough if everyone sat on it and just held it. It has to move through the system. Well, in the pandemic, guess what? There was a shortage. Banks were saying, hey, bring us your currency, bring us your coins, and we need them. So the current system was not flexible enough to deal with that, because it's not like the U.S. Mint's like, oh, hey, we got a bunch of warehouses over here full of coins and paper, just push it out. No, they had to get the machines turned up and try to meet the demand for it. So what does a digital currency do in that case? Well, it allows them to expand it as needed to meet the demands of the consumer. Now, it doesn't mean that, expand inflation. What we have seen in the past, and the Fed does a great job of managing, when there's demand, they expand the paper currency and then they destroy it. It's just how they work. It's not just this perpetual expansion of money. So I think that's where a lot of this is coming from, is central bankers are realizing, hey, there's potentially situations here where the current system is just not flexible enough to do what we needed to do. And what did we hear from Powell today? He said, oh, well, we're not really a huge rush to do this. We'll let some other people, because we want to do it right. So this notion that we're going to wake up one night and see two different types of currency in our accounts is not going to happen. I mean, someday there will be a digital, completely digital currency. There will be no more paper. But there'll be time. It'll be announced well in advance. People will know, go dig up all of your paper and coins and plan to turn them in. And then one day there'll be a one-for-one swap. That's what's going to happen. Now let's talk about this IMF thing, because when I thought we were just past digital currency, right? All of a sudden, boom, emails, messages. Oh no, look, IMF, inflation. Read this stuff. Read the stuff before you get too excited about it, because here's the thing that everyone is freaking out about is the new Bretton Woods moment by the managing director of the Washington, D.C. branch of the IMF. So let's go and look at what she actually said. And this is pretty interesting, because this turned into the whole Bretton Woods currency thing, and that's not what she was talking about. I'm going to show you, and let's zoom it up a little bit so you can get a picture of this. So she was talking about how she visited the Bretton Woods, New Hampshire, where the agreement was, where 44 men signed the Articles of Agreement. And they had our founders faced two massive tasks: to deal with the immediate devastation caused by the war and to lay the foundation for more peaceful and prosperous post-World War. And then at the conclusion, John Maynard Keynes, where everyone's now getting excited about it, captured the significance of international cooperation as hope for the world if we can continue. Quote, the brotherhood of man will have become more than a phrase, he said. Okay, so nothing so far about this new currency or new currency system or the end of the dollar hegemony. None of that. So today we face a new Bretton Woods moment. Big difference between moment and anything else. So she's talking about the pandemic now, and we have two massive tasks: to fight the crisis today and build a better tomorrow. Well, that sounds pretty good to me. So she goes on to talk about the pandemic, and here we have three imperatives. So let's go and see how many of these involve brand new currencies. First, the right to economic policies. What was true at Bretton Woods remains true today. Prudent macroeconomic policies and strong institutions are critical for growth, jobs, and improved living standards. One size does not fit all. policies must be tailored to individual country needs. Support remains essential for some time. Withdrawing it too early risk grave and unwarranted economic harm. The stage of the crisis will determine the appropriate shape and support. So what is she talking about here? Look, we need to be united on our fiscal and monetary front. Now, some countries are going to need more, some countries need less, but we need to work together. That's all she's saying at this part. So far, that's it. Now, let's go on, and she talks now about policies for the people. Well, we all like that, the second imperative. And she says to reap the full benefits of sound economic policy must invest more in people, means protecting the vulnerable, it means boosting human and physical capital to underpin growth and resilience. So she talks about health, education, gender equality, young people, internet. Nothing about a new currency yet. Nothing at all. Now, the IMF's role. Here we go, Steve. This is where it's at. This is where we'll find out. We're all going to wake up to a new world's reserve currency. The dollar is going to zero. And let's take a look at this. As the fund, we are working tirelessly to support a durable recovery and a resilient future as countries adapt to structural transformations brought on by climate change, digital acceleration, and the rise of the knowledge economy. Since the pandemic began, we have committed over $100 billion, and we still have substantial resources for a $1 trillion lending capacity. That's it. That's what she's talking about. Offering more loans to who? The urgent needs of emerging markets and low-income countries. That's it. That is it. And so she concludes by saying we should seize the moment. The best memorial we can build to those who have lost their lives in the crisis, in the words of Keynes, is the bigger thing. Build a more sustainable and equitable world. The founders did it. It's now our turn. This is our moment. So as you can see, there was zero commentary, zero references to anything about a new currency, the world's reserve currency, the dollar, anything like that. And yet, somehow that turned into, oh my God, inflation, inflation, inflation. See, we have this problem of anything that hits the news, oh my God, inflation. It's like, no, that's not how it works. But it seems to be that's what everyone wants to jump through. So let's talk about what's going on in the futures market, because I am very interested in that. And let's see what's going on with hedge funds. And it's particular interest with the 30-year. So here we have 10-year net longs. Again, these are futures contracts. We're going to do a little bit of deeper explanation of this short side of this market here in a moment. But here we have large specs are slightly long 10-year Treasury bonds, meaning they're betting on lower interest rates, higher bond prices on the 10-year. On the 30-year, they are still near. There's an article that says, speculators back off their record short position. Yeah, not by much. Back off. They're still very, very short. Now, so what they're betting on the 30-year is lower bond prices and higher interest rates. Now, who's on the opposite end of this trade in the bond market? That is the large commercial banks. So let's explain what's going on here with this shorting thing, because I'm not sure everyone fully understands it. Now, we do understand buying and then selling for a profit. So, example, if I bought something for 80, sold it at 100, make a $20 profit. I think we get that pretty clear. But when you're shorting something, it works the exact opposite. So for example, and these are not real numbers based on anything on the charts here. So let's say you're selling something at 100. Now, mind you, you're selling it and you don't own it. And the point is you're hoping it goes down in value, let's say to 80. You're going to buy it at 80, make $20 profits. That's what shorting is. Now, the reason this is so interesting to me, and you see the speculative short position where some people say, well, they're just hedging. They're not hedging. Yes, they do have long bonds. We do know hedge funds do hold a fairly sizable number of U.S. Treasury securities. They are trying to profit on a short term or a trend in the bond market. So they believe that interest rates are going up. That's why they have the second largest net short position in history, because they're betting, they're shorting, say at sell at 100. Hopefully I'm going to buy, somewhere below, maybe at 80, 70, 60, 20. It doesn't matter. They're going to buy at a lower level and make money on that exchange. Now, on the other end are the large commercial banks. Why are they on the other end? Well, because they're the dealers in this case. They're the ones who are in the position to take the opposite end of the trade. Now, do you think for a moment that the large commercial banks are willing parties to this trade knowing that, of course, let's just assume that interest rates are going to go up and the speculators are right, that they're going to lose money. Do you really think the large commercial banks are entering these trades because they have nothing better to do and they're going to accept taking a major loss? No, they're not. That's why they're the commercial banks. They're the smartest of the smart money. They know what's going on. They are willing parties to this trade because they think they're going to make money on it. And guess what? They have the ability to make money on it. You know, here's kind of how this works, right? You're out with your friends, you're watching a sporting game or some event or something, and someone says, hey, I got $20 on Team A winning. There's no contract form if there's no counter bet. The moment someone comes up and says, hey, what's that? Well, he's looking for someone, he's betting on Team A to win for $20. So, wait, I got $20, I'll take Team B. Now you have a contract. There has to be a willing party on both ends of this trade. So the banks don't just go like, oh, well, we'll take any deal that comes. Any deal. Anybody wants to short the market, we're on the other end. No, they choose to take it. So what you're seeing is speculators, mostly hedge funds, are betting against the large commercial banks. Not something that I would want to be betting on. And why are they doing it? Well, we can go to Jeff Snyder at Alhambra Investments, and he put up this great chart. And you can go to his website. I'll try to remember to link it in the description below. But what you can see is in this kind of a pinkish color is he's got the bank reserves. And everyone thinks an increase in bank reserves is inflationary, even though it's not. That's generally what the market believes. And so some of you are like, well, I don't think people believe that. Trust me, the market believes it. And so you see this big increase in bank reserves, and then at the same time, you see this big increase in short positions in the futures market. It's ridiculously short. Now you can go back, thanks to Jeff's chart, and you can see bank reserves rising back between 2012 all the way into 15, and you did see interest rates rise here a bit. And then what happened, because reserve assets are inherently deflationary, they're designed to lower interest rates, what happened after that? Interest rates went down. So speculators are betting there's going to be this sharp move higher. So far, no sign of it, none. And go back to, say, 2012, 2013, 2014 into 2015, there was a large speculative short position at the time, nowhere near where it is now. So what's interesting to me is, despite this record short position in the long bond, rates have really not moved at all. I mean, that should be more interesting for all the people like, oh, rates are only going to go one direction, up, 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 and up. They can only go up. What they should look at how many people are betting on it going up, and it's not. That should be the more interesting news here. So where are the commercial banks hoping for? Well, let's say that, so you have the speculators selling at 100, maybe the banks are buying at 100. Now, what do the banks want? Well, they want to sell at a profit. So we'll just say 120. So if they can get the price up and force those speculators that sold at 100 to buy at a higher price, you get a short squeeze. That's what makes this so interesting, because when you see a massive position in the market that's short, and you know for a fact that credit is contracting, you know quantitative easing is designed to lower interest rates, you know the banks are on the other side of this trade, it makes you feel pretty good about where bond prices are going. And they're probably not going down, because you think if they were going to go down, they probably should have gone down by now, because you have this just record amount of persistent selling against the bond market. So let's go back, put that over there. And what do you see? Well, these speculators were short when the 30-year was around 2.3%. And then they backed off a little, and then they increased their shorts down as it fell into 1.4. Then they backed off, and then they started increasing their shorts again. And we're right now around 1.5%, maybe a little bit more than that. And you have this massive short position, and potentially, due to the fact that they were short up here in the, say, 2.3 to 2.4 range, they're upside down. They're potentially upside down. And rather than just accept that and get out of their positions, they're doubling down. You know, they're buying the dip, hoping that they can dollar cost average their position back if rates go up. If rates don't go up, and they so far have not gone up, well, it puts the speculators in a dire position to get squeezed out of this position and lead to ultimately lower interest rates and higher bond prices. Let's take a look at the other speculative positioning. We've got West Texas Intermediate. The longs are slowly backing off. No real change in oil prices, sitting around $40. The S&P 500, they backed off their longs slightly, but are still long the U.S. equity market there. How about Euro futures? This is opposite of the dollar because of trade-weighted dollar. Big component of it is in euros. They're backing off slowly as the dollar looks to be getting ready to make a move higher. How about gold? No real change in gold as it's slowly heading down. Of course, everyone says this is the big consolidation before it rockets straight up. We'll see about that. How about the NASDAQ? You want to know why the NASDAQ moved higher last week? Because those short positions got squeezed out into longs. That can happen in the NASDAQ. Wait till it happens in the bond market. How about the Russell 2000s? Bullish bets on the small caps increased slightly. And taking a look at the dollar, they're finally moved slightly long on the dollar. Just a smidge, but this is a beginning. Remember, when the speculators start to move long on the dollar, it's going to send it a whole lot higher, and then you get that trifecta of tightening. How about the VIX futures? Lowest level since January. I'm watching VIX at 31. I think if you break 31, you see a bigger move higher in the VIX. Let's take a look, make a quick look at the charts on that. Are we in the right spot? No, we are not. How about now? There we go. So here we have the record short in bond market. This is TLT, long-term Treasury bonds, record short positioning. And what happened? It held the 200-day moving average, and then it went up, hit this resistance level, this downtrend line. Sellers came in, thought they got it today, held the 200-day moving average again. Again, you have this massive short position, and some reason they can't even get bond prices back down to where they were in June. And think about this. When prices get up here and squeeze out these shorts, this is a big area here. There's a lot of selling that went on in here. And this is where you potentially get a big move higher as bond prices get up into here, start working through these shorts, and it could just be a catalyst for shooting bond prices higher. And we can go back and look at prior areas where we've seen sellers get into a consolidation zone, and once it broke out, it flipped a lot higher. This is much bigger and longer, suggesting that when bond prices eventually do move higher, and there's certainly no doubt in my mind that the large commercial banks are not taking these positions because they think they're going to take a loss. Remember, they tighten financial conditions. They're the ones who aren't lending. They're the ones who are driving this boat. They know what's going on. Let's take a look at the VIX. Jumped up to 29 today on, of course, news that there may not be a stimulus bill. As I said, there probably won't be. Time is almost out to get that done. If there isn't one, look for February potentially. Then at the next point we'll have when the economy will be in much worse shape by then. The VIX gets over 31 and maybe the big party begins and this thing shoots higher all the way. Maybe it gets back up in here like it did back in March up into the $70 to $80 range. We'll see. But I'm watching this 31 level as a catalyst to set the VIX higher. So with that, please be sure to like. I want to thank all those from Mark Moss who are joining us. Hope you enjoyed the interview. Be sure to subscribe. We're welcome to have you. And we'll be back on Wednesday. We'll see what kind of economic data we have and some other interesting things. But remember, everyone's betting against the banks. Not something you really want to do. So I hope this helped. Take a look at that. I'll put the links in the description. Be sure to read that IMF thing. I think you'll find it as interesting as I do. And with that, I'm Steve Van Meter. Thanks for watching. I'll see you on Wednesday. Bye now. The content of this video is private educational information only. It's not intended to provide investment or other advice. It is not to be construed as recognition or solicitation by selling security, defense, or instrument, or participate in any particular trading strategies. Video was prepared by Steve Van Meter on personal capacity. Opinions expressed in the video that do not reflect the view of Atlas Financial Advising or Steve Van Meter Financial.